Founder of Pitchboard, and welcome to the Pitch Podcast. We are here to have thoughtful discussions with forward-thinking managers who are taking unique approaches to professionally investing capital. Through these conversations, we hope to introduce you to new ideas and strategies that will help you better manage your own portfolios.
Before we begin, we want to remind our listeners that everything in this podcast is for educational purposes only. Nothing here is tax, legal, or investment advice. We don't endorse any products, services, or opinions made by our speakers. Some statements in this podcast may contain forward-looking projections. These projections do not guarantee future performance, and any past performance does not guarantee future results. Finally, nothing in this podcast is an offer to buy or sell securities. Speak to your own advisor before making any financial decision.
The thesis was there was a glut. There certainly was at the time. The stock was down some 90% from its highs in 2013, 2014. We were buying at $11.80 to $12.20 when we started. The stock was down from some $90, so we thought we were doing a good job. We had confidence it wasn't going to go BK. And it quickly thereafter jumped to 18. We picked the bottom almost to the T. We were brilliant, except for the fact that COVID came and the stock collapsed down to $1.61.
Hi, this is Andrew from Pitchboard. Today I have the pleasure of speaking with Tom Hayes, Chairman and Managing Member of Great Hill Capital, LLC. Great Hill is a long-short equity manager based in New York. Tom, welcome to the podcast. It's great to have you on.
Thanks for having me, Andrew.
You're also, as I understand it, a podcast host. So now you're on the other side of the recording, so to speak. Can you tell our listeners a bit about your background in financial markets, how you came to work at Great Hill?
Yeah, so Great Hill, we started 7 years ago. And prior to that, the first fund I was with was called Bedford Oak Advisors. The principal was very close friends with Warren Buffett. So I cut my teeth as a value investor. The four seed investors were Mario Gabelli, Michael Bloomberg, Sam Zell, and Phil Frost of Teva. So it was an all-star cast, and we saw a lot of good deals. And I got involved with a lot of good stocks. So learned a tremendous amount there. And then in summer 2012, I actually sent an idea to Cornwall Capital. You may know the name from The Big Short. I reported to Brad Pitt, Ben Rickett in the movie, Ben Hockett in real life, and Jamie May. And basically, soybeans were at a generational high, 1800, and the market was pricing in that it was never going to rain again. I mean, if you looked at the weather patterns for the next 90 days, there was not 1 ounce of precipitation in the Midwest. But more importantly, I saw that commercials were getting aggressively short, and they tend to get short ahead of big moves. And I wrote this up. They put 1% of their equity at the time in the idea. The idea was long puts, and they made 5x. They made about $25 million in 12 weeks. And they said, "What would you like to do?" I said, "Well, I'd like to work with you on a consulting basis." I did that for a few years, was phenomenal. And then I started my own fund with Great Hill Capital. So that's kind of the short story of my background.
And I think that's a great lesson in taking chances and reaching out to people, because you definitely made them enough money to be able to, I'm sure, to afford your consulting services, I hope. So for those of you who aren't familiar with your firm, can you talk a bit about what you do, what kind of clients you have?
Yeah, so we run a long-short equity strategy for accredited investors and qualified institutions in a separately managed account format, full transparency, and quarterly liquidity. We charge a 0% management fee. We take a performance fee on the basis of size. It ranges from 25% down to 20%, depending on the size of the account. And clients like that. They like the liquidity. They like the transparency. And, I tend to attract just through word of mouth. We're out there. People see our views. They see our mindset. So I have a tendency to attract like-minded investors and partners, which is great, because I think we're going to go over a few ideas that we've done in the past that basically, when you know what you own in the short term, you can handle the short-term volatility of dislocations for the long-term reward of multiple upside in different names. And those are the type of partners that I like to attract. When I started out, it was, you take who you can get. And as you evolve in the business, you take who you want. And the key there is, if you have a stock, for instance, in summer and fall of 2020 during the pandemic, we were pounding the table on Wells Fargo and we started buying at $28 and change, it moved all the way down to $22 before rebounding. But when we were buying at 22, the phone calls I got from my partners were not, should we sell out? It was, can we buy more? What can we sell to buy more? And to have the like-minded people, our basis was 25.01. We peeled off quite a bit in the high 50s, but we think that thing has more room to run. But that's just an example of kind of the type of deep value that we look for. In the case of Wells Fargo, that was a stock, it was trading at 40% discount to book. It had only done that 2 other times in the history of the company. They were around when there were horses and buggies, if you know from the pictures. It happened during the S&L crisis in the early 90s. It happened during the great financial crisis, and it recovered back to premium to book within months, not years. We expected the same thing during the pandemic, and that's the exact result we got. So while the consensus was DeFi is going to change the world, who needs branches and pens with chains on them? We said this is an opportunity of a lifetime. We got aggressively long, and having the right type of partners to ride it from 28 down to 22 before it went up to 59 is the type of people that we attracted. Part of that is from what they see when I'm out, whether it's on Fox Business or on media, or also I do get clients from our weekly podcast and video cast, Hedge Fund Tips with Tom Hayes, which is pretty popular in the institutional investment community, the journalist community, and ultra high net worth investors. It's quite an audience on that front. So over time, some clients have come to me, I've been listening to you for 6 to 12 months just to see if you were right. I want to put money with you now. And we have the conversation. And that's how we like to do it. Attract the right type of people. We're also finding we're attracting the right type of employees who are already trained to listen to our material for months. So we're not getting growth investors chasing breakouts. We're getting value investors that know what they own and look for high quality businesses when they're on sale.
I think you've maybe already gone some of the way to answering this question, but are you a believer in diversification for the sake of diversification's sake, or are you comfortable taking big positions when you're confident in your thesis?
I think the latter. I do think there's value in diversification, meaning you don't want to have 10 positions, 4 of them in the same sector. So if you have 10 positions or 5 positions, you definitely want to have them in different sectors. You want to make sure you don't have a high correlation for such a high percentage of your portfolio. But when we do have a high conviction in a particular idea, we do lean in, and we'll go as high as, in some cases, 20% in a position, like we did with Wells Fargo. And like right now, we've got 2 ideas that we're happy to talk to you about. I think we're going to do that towards the end of the call for 2022. And we're leaning into both of those positions in reasonable size. So we might have many more than 10 or 15 positions on at one time, but the second half of the portfolio, they're de minimis and they have modest impact. Our gains are made from, basically a handful of higher conviction positions.
So let's talk about the Wells Fargo trade. When you started it, what did the initial position look like as a percentage of your portfolio?
It was probably about 8 to 10% initially. And then as it moved against us, we just leaned in down to 22 and wound up with about a $25.01 basis in that position. And, there were other factors. It wasn't just a discount to book. It was the acute nature of the pessimism and sentiment. And most importantly was the accounting change. So in Q2 of 2020, banks had to comply with a new change called CECL, Current Expected Credit Losses, which effectively meant they had to account for the worst case scenario of credit losses imaginable all up front. Who came up with this idea, I have no idea, but probably the same person who came up with FAS 157 that caused the great financial crisis. But leaving that aside, economists at that time were all in a circle talking about 20% unemployment, that GDP would contract as much as 12%. And this was after the Fed backstopped the corporate credit market. It was mind-boggling to me that they were still having these fantasies. But leaving that aside, I guess they only read one book and it was written in the 1930s. We took the other side, and Wells Fargo, as a result of this, had to take over $20 billion in reserves. And we knew that would be coming back sooner rather than later. It would come back as earnings. And we've certainly seen that over the last 7 or 8 quarters. And that's what's propelled the stock. And keep in mind, there's still another catalyst on the horizon with the name for those of you who still hold it. And that is the asset cap being lifted, the asset cap from the account scandal and all the things going back many years. So that would be another final catalyst. So there's still upside, but for us, we like to take the middle out of it. We leave, we don't pick the final nickel or quarter up in front of a steamroller. The yield curve has certainly been flattening since last June. It was meaningfully more than a double, and we'll keep a tail on that for sure. We want to participate in the upside, but it would have to, pull back materially at this stage for us to reload.
How do you deal with risk management when you're taking such a large position? Do you have, whether it's a stop loss or do you have a level of, you just don't add more? Does it keep you up at night when you have to have?
The most important thing is knowing what you own. I mean, at the end of the day, if the business is complex or uncertain, or we're betting on, what's next, like, is it going to be Rivian or Tesla? Like, that's a game we don't play. We buy businesses that have strong, established, consistent earnings power over a material amount of time, that have been dislocated in the short term due to some exogenous event or some temporary setback or bad headline or something along those lines, that we take a look at the earnings power. Is this going to be materially impaired, 12, 24, 36 months out? And if not, why is the stock down 50, 60%? And then we try to understand the short thesis aggressively and understand why people would be selling it and or shorting it. And then if we think that thesis is incorrect or overestimated, then we want to get aggressively involved. So we'll start, for high conviction in that 8, 10, 12% range. And then if it moves against us, that gives us the opportunity. Why is it moving against us? What facts have changed? No facts have changed. It could be fund blowups. It could be structural issues. It could be general market dislocation. Then we want to lean in because nothing's changed in the material earnings power and outlook of the business. And that's kind of how we do it. In terms of risk management, I mean, very few times would we go up that aggressive unless the conviction was extreme. And it was in that case. And it is in a couple of cases we're going to talk about towards the end of the podcast. But largely, we manage risk by sizing and knowing what we own and the track record of the business. So I get an awful lot of questions on the podcast. We allow people to send in questions, and they're always asking about, new companies that have gone public in the last year or 2 years and are down because they know we like to buy things when they're out of favor. But more often than not, I say this goes in the too hard box because I just don't have enough information on how they perform through different cycles, through different dislocations, et cetera. I want to deal with more established businesses that just happen to be out of favor for one reason or another, or sectors.
And is that how you avoid falling into the classic value trap situation? I mean, this must, I guess for all value investors, that's the big risk, right? That something that you're buying it seems cheap now and it keeps getting cheap, and that there's maybe some underlying reason you may not know about why it's getting so cheap in it.
Yeah. Well, I mean, if you want to talk about a semi-failure that turned out well, we could skip over to the Range Resources story. Happy to talk about that. That might kind of give you an insight into how we deal with those type of situations.
Sure. Yeah. Let's talk about that.
Yeah. So energy was definitely a value trap in 2018. Range Resources was a natural gas company. Obviously, the thesis was there was a glut. There certainly was at the time. The stock was down some 90% from its highs in 2013, 2014. We were buying at $11.80 to $12.20 when we started. The stock was down from some $90. So we thought we were doing a good job. We had confidence it wasn't going to go BK. And it quickly thereafter jumped to 18. We picked the bottom almost to the T. We were brilliant, except for the fact that COVID came and the stock collapsed down to $1.61. So here we were, $11, $12. The stock got away from us at 18. We don't add up. We don't buy up. We only buy down. But the COVID situation handed us a gift on a silver platter. And we averaged all the way down. Literally, we had some purchases in the $1 and change. Our basis came down from over 11 to $4.11. Today, the stock is trading up to, I think today it even traded up to 25. It was a six-bagger, so now it's moving higher. But what gave us confidence? So, at the time we were buying the stock, the proven reserves that they report to the SEC, 10 years was worth about $23 a share. So it was trading at about half of liquidation value, even with the depressed prices of gas in the market, even with all the sentiment. If they had to liquidate it immediately, we felt pretty confident they could get $20 to $23. But what they don't have to report or can't report is the unproved reserves. They had another 20 to 30 years of drilling that they owned, and that was worth somewhere in the neighborhood of, depending which sell side you listen to that knew what they were talking about, $40 to $46. So, we had a stock that was down from 90 to 10 or 11 that was probably worth, as the market ultimately worked itself out, $50, $60, $70. And leaving that aside, it's the sentiment overshoots that is really our knitting, because at year end 2013, when it traded up to $90, it was trading at 175% of their SEC PV10, the proven reserves. When we started buying, it was trading at 41% of its SEC PV10. So it shows the extremes. The underlying value didn't change much. It was just what the market was willing to pay for that similar value based on euphoria or despondency, and overall sentiment in the market was dramatic. So, one of the themes that we're going to talk about towards the end, it's the exact same situation right now. If you look at the long-term multiples of this particular sector and how they vacillate around the average over time, these type of opportunities show up. So you can't pick the exact bottom, but when you know what you own, and I knew on the downside, the thing was worth $23. On the upside, it's worth 60 or 70. We have no intention of liquidating that stock until probably in a material way in the mid 40s to high 40s, because we think the intrinsic value is materially higher. And we felt that way since the first share we bought, even as it was moving against us and all the sentiment and oil was done and we're going to green everything overnight. And we found out, pretty acutely in the last few weeks, that's not the way it works.
Other than looking at financial metrics such as, discount to book value or to the proven reserves, how do you assess sentiment as an investor?
Well, it's part of the reason that we like to deal with established businesses that have a long track record. So, you can get a sense of what range of multiples companies have traded in over the long term, price to cash flow, price to, earnings, and see, oh, okay, this is oscillated between 13 times and 24 times. It's trading at 11 times. Why is it doing that? Has the growth rate materially slowed? No, actually forward growth is looking like it's going to be better than it was the last 5 years. So what's happening in terms of sentiment around the sector? Why is everyone pessimistic on it? And you can usually unpack the short narrative and then determine, okay, how much of that is actually priced in? Because there's probably merit to a reasonable portion of the consensus short thesis, but is it overshot? So if they're right, what should the price be? And more often than not, the price is higher than the price at which we're looking at entering the business. And then it's just, waiting for that to be realized by the market, or in a better case scenario, some exogenous catalyst that we can identify that's on the near-term horizon that would get us acting more quickly. And in the case of Wells Fargo, it was that these reserves were going to come back as earnings and lending would increase, C&I would increase, the customer would come back, we'd get a vaccine, et cetera, et cetera, et cetera. And you have a whole litany of catalysts that you can identify. And then when they happen, you can check off, which is why I mentioned the asset cap being lifted is one that, we lighten up a lot in the high 50s, even before that final catalyst, but we kept a tail on because we know there's more upside.
Has there ever been a case where you took a position in a stock that was seriously unloved, if not hated, and then you started taking a look at the short thesis and were convinced by that and reversed your position? Has that ever been the case, or that you maybe altered your approach?
More often than not, if I couldn't understand why the shorts were wrong, even though I really felt it was undervalued and they were probably wrong, but I couldn't make a compelling enough case to disprove their thesis, then we would just avoid the stock.
Right.
That's really it. StoneCo is a Brazilian company that's really cheap right now, but it's really hard to get high conviction. The thesis is actually that they have these Chinese terminals that, could have risked the data, and they're having FBI raids in the United States, but their business is largely based in Brazil. So, we're drilling down a little bit more on that. With the consumer businesses, though, there's a lot of gotchas that can make you uncomfortable. So that right now is in the too hard box, because we can't fully disprove the short thesis in a way that makes us want to get any size in the stock. We may put a little flyer on it, but to materially lean in, that just would go in our too hard box and we take a pass. So that's kind of how we deal with those situations.
Right. You've got at least two big ideas for 2022. So let's maybe talk about the first one, Alibaba. Why do you like it? Where do you see it going?
Yeah. So Alibaba, it's interesting. Bill Miller was out on CNBC this morning saying that he was adding to his position. It's the cheapest large cap stock in the world right now. He was preaching to the choir. I felt like I was the only person listening in. Absolutely a man after my own heart. But this reminds me a lot of Microsoft in 2013 before it took off on an historic run of 1,500% over the subsequent 8 years. From 2006 to 2013, Microsoft grew revenues per share by 112%, cash flow per share by 193%, and earnings per share by 120%. You have any idea what the stock did over that 7 years?
I'm guessing it was flat to down.
Exactly. Absolutely nothing. And, people suffered through that. And by the way, in the subsequent 8 years, where the stock went up 1,500%, the underlying performance was not meaningfully better. So a lot of credit is given to Satya, but the foundation may have in fact been laid by Steve Ballmer, and he doesn't get a lot of credit, but he's made a lot of money, so no one's pulling out the violins. What we see with Alibaba is a similar situation. Again, exogenous events, regulatory crackdown, Chinese Communist Party shut down the education sector and scared the hell out of every foreign investor in summer of last year. Unprecedented in that regard, highly precedented in the scheme of cracking down on tech companies, cracking down on online gamers. We see that story every 3 to 5 years like clockwork. It's a regular occurrence. We also see every 5 years with the China National Congress, the political transition, which is coming up in November, that the Chinese government cracks down with a heavy hand 2 years before that event, a year and a half before that event, asserts their communist authority and power. The economy slows, then they have to panic into stimulus, easing, and economic growth in the 12 months leading into the China National Congress, which is this November. And we've already seen them begin aggressive easing since October and November of last year after the heavy-handed crackdown in August and July. So leaving aside that macro view, let's take a look at the numbers. Since Alibaba's gone public in 2014, their revenues per share have grown by 894%. Their cash flow per share has grown by 559%. And their earnings per share has grown by 601%. And yet you can buy the stock for the exact same price you could in 2014. So just like Microsoft, the people that suffered through 2006 to 2013, and then if they held on, got the benefit of a multi-bagger, I think that someone else has already paid the fine in the last 7 years, and those people getting involved at this stage will enjoy the benefits. Now, I don't think this is going to be a 1,500% return, but we do put the intrinsic value somewhere in the neighborhood of 300 in the short term, assuming the regulatory environment remains stringent, and it could be worth much more when you consider the growth of the cloud, how they've been able to perform in the face of extreme regulatory crackdown, still growing top line. 2 quarters ago, 29%, last quarter, 10%. And, even if their historic growth rates were cut in half, which we're more optimistic in terms of AliCloud and in terms of the international growth that we're seeing, it's trading at 11 or 12 times forward earnings. So what do you pay for a business growing at 15, 20% over the long term that has a reasonable moat in China with 1 billion users, internationally growing in leaps and bounds, 384 million some odd users and growing, and a nascent equivalent of Amazon Web Services with a faster growth rate over time? We like those odds. We like, obviously, the people who are involved. You saw Charlie Munger was in the 200s. It got down to 160, he doubled down. It got down to 110. He doubled down on his double down and added a little bit of margin debt at the Daily Journal. So that's comforting to know that there's some smart people like Munger and Bill Miller involved as well. So we think something like this is a no-brainer, but these things, they move against you. You increase your position because you know that whether it's 12, 24, 36 months down the road, you want to bring that basis down so you've got at least a double bagger. But I think that for those that have willing to deal with some short-term white knuckles, you could have a 3-bagger, and if not more over time as the business evolves and grows in the fastest growing part of the world.
Fair to say that the main risk with buying a company right now like Alibaba is geopolitical risk, both either in terms of a further crackdown by the Chinese government or somewhat like we're seeing with Russia, that maybe Western investors decide that China's human rights abuses are not, they don't want to be associated with a big Chinese company. Is that the big risk? And to what how do you factor that into?
The underlying assumption that I have to take with any investment is there's something that I don't know that I don't know. So even in the rare instances that I'm willing to lean in aggressively and move that over 10% to 15%, closer to 20%, which is very rare instances in my career, I have to assume that that can go to zero and would I live another day? And I'm perfectly comfortable with that. I'm comfortable with the rest of my portfolio knowing it could pick up that slack. And I know that the odds of that are so remote, it's highly unlikely. The other thing that I know is that politicians' number one job is to get reelected. They'll do that at all costs, or in the case of communist China, retain their power. And what they figured out when they shut down the education industry is they had 500,000 people that were out of jobs and they had to figure out what they were going to do. What they also figured out was that there was some dissent. There were different documentaries out about China corruption, and it became kind of dissent and criticism of the current government, which they weren't expecting. And those type of things usually only happen when the economy is in shambles. The other thing that's worked against them is the zero COVID policy. It's very tough to grow and plan a business. One day you wake up and your whole city shut down because one person got COVID. So I think as they run through their Omicron cycle, which is a little delayed from us, their immunity will go up as we've seen in the United States, and that will be in the rearview mirror. And we'll see a massive increase in consumer confidence and consumer spending. Because look, it's not just when businesses shut down. When businesses shut down, employees don't have work. When employees don't have work, they don't have confidence, they don't spend. And we saw that in the consumer spending numbers in the last couple of quarters. We're seeing some signs that that's starting to improve after the Olympics. And we think that that's going to be the trajectory moving forward. And we want to participate that. And we think Alibaba is one of the best valued ways to get broad participation to that trend. And also, in terms of the macro scheme, Andrew, the MSCI China on average appreciates 31% in the 12 months leading into the China National Congress. So we expect the stimulus, which started in October, November, to kick in on a lagged basis, 4 to 6 months. So we're bumping up against the time where that's going to be felt in the economy. And historically, Alibaba has a tendency to outperform the MSCI China in periods of appreciation, usually by about double. And then the final thing I would say about that is the Hang Seng has traded, which is China tech weighted, has traded at a discount to book just a handful of times in the last 25 years. It's done it now. It did it in 2020. Over the next 11 months, it was up 35.99%. It did it in 2016. The next 23 months, the Hang Seng was up 82%. It did it in 2008. It traded below book. The next 21 months, it was up 110%. And it did it in 1998, traded below book. The next 17 months, it was up 156%. Now, Alibaba was public only during 2 of these times. So in 2020, when the Hang Seng was up 35.99, Alibaba was up 70%. And in 2016, when the Hang Seng rebounded 82%, Alibaba rebounded 234%. So we like the China Hang Seng story at these valuations, and we think Alibaba will be one of the greatest beneficiaries, in part because of its weight.
How long are you willing to hold a stock that you think is deeply undervalued to see the market realize it's undervalued?
I'm willing to wait as long as it takes, provided nothing's changed in the underlying story that was unexpected or would lead to a permanent impairment of the earnings power of the business. And we believe that a permanent impairment is beyond priced into Alibaba at these levels. And our thesis is that it's a temporary impairment. So if it's a permanent impairment, the stock is probably worth $200, and that's on the ADS. If it's a temporary impairment, it's worth, the intrinsic value is probably 300 and beyond. It's just a question of time. So, if the stock moves against us further, we're pretty well leaned in. We probably add at the margins at these levels, but we think kind of the pain is now in the rear view mirror. We got the last bout of bad news in with the recent earnings. You knew the earnings were going to be difficult based on the consumer spending numbers and the economic numbers in the fourth quarter with China, following the lagged effect of the regulatory crackdown over the summer. So all of that is out now. All the funds that blew up in the name are out. it's almost at the point, to Bill Miller's, this is the cheapest large cap stock in the world with, by the way, a tremendous growth story. It's not just a value stock that's cheap because it's cheap and has low prospects of growth. In the case of Alibaba, I think the cloud business is in its relatively nascent stages. And I think their international expansion is in its relatively nascent stages, as evidenced by their growth rates in both.
Let's talk a bit about biotech. I know Alibaba is a stock you like. Biotech as a sector you like right now a lot for 2022. Can you outline your thesis for why you think biotech is compelling?
Yeah, so we took a look at the top 30 weights of the biotech sector. I mean, I'm not smart enough to figure out one by one and figure out what their patent pipeline is going to do and who's going to have the next big breakthrough. There are specialized funds that are far better at that than we'll ever be as generalists. But what I would say is I like dislocation. And if you go back to November, the top 30 weights of the biotech sector, their earnings power for 2022 has come down by 40 basis points, cumulative earnings power of the top 30 weights, while the sector or ETF or however you want to measure it was down over 37% over that same period. So very de minimis impairment in the cumulative earnings power, meaningful impairment of the price. So why was that? Why was the price so impaired? And in part, it was a function of rate hike fears. So there was a tremendous, you saw obviously all the innovation stocks, et cetera, the stocks trading at 10 and 20 and 30 times sales that were making no money. In other sectors were taken out to the woodshed and they were down 50 to 80%. And many of those are still trading at 10 or 20 times sales. So it's like, well, how do you actually pick the bottom in stocks like that? But that's separate from biotech. What we find with the biotech sector, so we thought, number one, that dislocation was very interesting. Let's take a look at how does this compare with how the sector has been measured historically? And if you look at the average multiple since 1986, what you find is that at the current valuation on price to book value to start with, the sector would have to appreciate 24% just to get back to its average price to book multiple since 1986. It would have to appreciate 155% to get back to its average price to operating cash flow multiple since 1986. And the sector would have to appreciate 112% from here to get back to its average forward PE multiple since 1986. Now, the one thing that we know as kind of like people who pay attention to sentiment and extremes and euphoria and despondency is that when these revert back, they don't revert back to their average. Just as they overshot on the downside in despondency, pessimism, and structural deleveraging for people who were over-levered to a particular stock or sector, when they recover to the upside, they have a tendency to overshoot on the upside. They don't just get back to average and stop. They overshoot and oscillate around that long-term mean trend. And we think that will be the case in the case of biotech. There were also fears about the drug pricing. What was in the build back better is now the build back burner. Not going to happen. Maybe they'll get something done on insulin, but that doesn't affect the large part of the sector. And the other thing you find, there are over 100 companies trading at a discount to the cash on their balance sheet. No credit for intellectual property, R&D, patents, buildings, employees, nothing. And at those type of extremes, it's a good time to, in our experience, get exposure. We also find that the narrative is in a rising rate environment, you need to be in cyclicals. And history doesn't bear that out. What history bears out is what we like to say is the time to buy insurance is before your house is on fire. So we were getting pound the table aggressive in cyclicals like energy, banks in 2020 in anticipation of the high GDP growth and inflation off of a low base. That's the time when cyclicals dramatically outperform into the first rate hike. In the 6 months following the first rate hike, historically, the top two performing sectors are real estate, REITs, and tech. Tech in the 6 months following the first interest rate hike on average is up 11.2% as a sector. If you talk to people about tech right now, no one wants to touch it with a 10-foot pole because they got burned. And what in fact is going to happen and how people aren't positioned. If you look at the Bank of America Global Fund Manager Survey, they've got their highest underweight, they're 9% underweight tech. The last time they were this underweight tech, institutional managers that participated in this survey was December 2008. If you'd bought a lot of tech in December 2008, we wouldn't be on this call. You'd be on your yacht sipping pina coladas. And I think that the bifurcation that people have to keep in mind is value tech that are trading at reasonable multiples, generating cash today, which are useful in an environment where capital begins to have a cost, versus dream stories where it's manana, big on promises, small on profits, trading at 10 to 20 times, 30 times sales, which worked when capital was free and may not work quite as well when capital begins to have a cost.
If tech right now is one of the most, if not the most, underweight sector in investors' portfolios, what's the sector right now that you think is the most overowned and where there could be mean reversion on the other side?
I'll tell you what we've been doing in the last 2.5, 3 weeks. We aggressively went into energy in 2020. We have been dramatically lightening up into this strength. It's not to say that it won't push higher until the Ukraine is resolved, et cetera. What you actually see is that managers right now, just as they're the most underweight to tech as they've been since 2008, they're their most overweight to cyclicals than they've ever been in history. The last time they were this overweight to cyclicals happened 3 times: January 2018, January 2011, and mid-2006. All 3 times were short-term or near within a month, month and a half, short-term tops in banks, energy, and materials. And I think that what we're going to find is, when we were pounding the table publicly on energy and banks in 2020, you couldn't give them away. Now that everyone's tripping over themselves in the last month trying to get energy exposure, you can't get enough of it. And that's when you want to help people out. And sure, they could push higher, but I think you're going to find in a month, 2 months, backwardation in the curve and everything else. The Iran deal that's imminent, that'll put 1 million to 1.8 million barrels on the table. Probably some negotiated settlement with Russia, Ukraine. I think you could see the trapdoor is going to open and let out all the Johnny-come-latelys in a pretty abrupt manner. And no one is positioned for that at the moment. And sentiment is in no way lined up for that. And I think that's where the risk is probably in the next 2 months. And if you get a meaningful enough pullback, which I'm not certain that you will, we did keep some servicers and we did keep our natural gas plays, including Range Resources, but we got rid of a lot of E&P that were up. Many of these stocks, by the way, are up 2 and 3 and 4 times, and now everyone wants them. That's not the game we play. So we'll lay that off, let someone else pick up the quarter in front of the steamroller. And if we get a meaningful pullback, we'll reload. We're in line with kind of a 3 to 5 year commodity cycle. But the euphoria and the panic buying in these groups leaves us to believe that a shakeout is probably in the cards in the near term.
Speaking of commodities, where do you think we are in that? Sorry, are we 2 years now into that 3 to 5 year cycle?
Yeah, it's very hard to tell. The rig count from the 2020 troughs are up 164%. So a lot of people say, well, no one's drilling. They are drilling. It's just public companies are more disciplined because public investors basically said you need to return capital and show capital discipline or you're not getting any money. But guess what? They sold off those rigs to private equity that don't have to answer to the same authorities. And the drilling is coming on fast and strong. And high prices cure high prices, low prices cure low prices is the long-term cliche in the energy and commodity sectors. I think that in the short term, whether it's a month or 2 months, we will get an abrupt shakeout. How material that is whether we'll want to reload selectively on some of those groups. But I do think servicers are going to be interesting because that rig count with prices where they are, even if they come down to $60, $70 a barrel, the rig count's going to keep accelerating and services are going to do just well. And servicers have also lagged in the recovery relative to E&P names. They have a different type of leverage. So I would be inclined to re-participate in energy on a material, scary pullback where people say, see, it's happening again, the rig count's up, blah, 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 because I think the demand is going to continue to be material. I think that provided the Fed doesn't invert the curve inadvertently by focusing too much on hikes versus re-steepening the curve with balance sheet roll-off, I think this cycle can extend for some time. I think also you have the lagged effect of immunity rates in the developing world and in the emerging markets we've in effect been blessed with Omicron because we've got a reasonably high level of immunity, and we're going to see that. You saw it in Target earnings yesterday. The top two sellers are suitcases and swimsuits. So, everyone's back into traveling and getting out there. And we're going to see a shift from demand for goods to demand for services, which is going to go some way to help inflation outlooks. Expectations are more important to us, 5-year break-evens than, short-term prints. 5-year break-evens have moved up 3.2%, but that's in line with norms since 1920. So it's provided expectations stay pegged in that range, I think we're going to be perfectly okay for the consumer moving forward. And if the Fed is successful in re-steepening the curve, we can extend the cycle meaningfully moving forward.
And speaking of the Fed, do you see them deviating from the path they were on because of the crisis in Ukraine?
I think the only thing that Ukraine changed was there was a chorus of people calling for 50 basis point hikes. Many of those people were positioned to benefit if yields went up. But leaving that aside, I think that it took 50 basis points off the table in the short term, which is positive, because if they had started with 50 basis points, then the expectation in subsequent meetings would have been 50 basis points, and then you're inverted before the end of the year and it's game over, or immediately. Now that they've started with 25, the 50 conversation is kind of off the table, and it's more in line with, okay, 25 a meeting, and then how quickly are they going to start balance sheet roll-off? I think that they can start, last time they waited a year and a half, and it was the appropriate thing to do. I think with the flattening of the curve, it would be good to put some supply of long duration treasuries on the market and see if we can't re-steepen the curve once again.
Do you see any repeat of the 2013 taper tantrum?
Well, the taper tantrum in 2013 was in expectation of the announcement. They didn't start the taper till December, the implementation, and the tantrum started in March. So we've kind of already worked through the fear and the tantrum and the re-rating, multiple re-rating, and the sell-off. So I think that's more of a rear view mirror situation. They've now put out 2 Fed minutes where they've pretty transparently even put out principles of how they're going to reduce the balance sheet. So the market is pretty well tempered. And this kind of, dovish pivot, you could say, in the last 48 hours, and what you saw in the testimony today of, him explicitly saying it's only going to be 25 basis points, beyond that, talk to the hand, is a very comforting thing for the market. It gives some clarity and shows that he's learned something from December 2018 when he threw the market off the cliff, because he was fixed to a predetermined plan, irrespective of the data and market around him. And if not for Stephen Mnuchin calling things together, I think it was on Christmas Eve, that could have been a lot worse. So he took his medicine early, and he's had a steady hand ever since. I mean, what he did with Stephen Mnuchin to pull us out of what could have been what those economists in the circle were fearing, they took that off the table very quickly, very aggressively. And now they just have to rein it in a sensible, tempered manner. And so far, it seems like that's the path they're on.
Do you have any opinion right now on where we are in terms of valuations for the equity market in general?
If you look at earnings for 2022, we're going to grow 8.5%. They've been creeping up very, very slowly. We're looking at about 225.42 for the S&P 500 for 2022, 248.07 for 2023. So you've creeped under 20 times forward. Looking 12 months out, it's obviously above the 5-year average of 16 or 17 times. So we are a little fully valued. Rates are still low. There's still some lagged effect of stimulus. There's still M2 money growth is up still 12.65% year on year. It pales in comparison to a year ago when it was 26% year on year. But you couple that with a lot of companies borrowed when money was free. There's $1.23 trillion of buybacks authorized for 2022 so far. That's a record high. You look at the economic surprise index, it hit 40 in its most recent reading. That's the highest in almost a year. So, I think index buyers are going to be punished. I think they're going to be in this sideways grind shop for de minimis returns. If you look at 8.5% earnings growth, maybe this year we'll finish up, high single digits, low double digits with some more volatility through and through. But I do think that there's meaningful opportunity in discrete places underneath the surface. So for our money in 2022 into 2023. We think there's a tremendous opportunity in China tech. We talked about Alibaba. We think biotech, and we think some selective value tech is getting cheap, like Facebook trading at 15 times forward, and some other names. Even some semiconductors are starting to look modestly reasonable. So there are things to do. Would I be, levered long the general indices? Absolutely not. It feels fully valued. The returns are going to be more modest moving forward with higher volatility, but on a sector by sector basis, on a company by company basis, there's plenty to do. I mean, you see the statistics of the percentage of NASDAQ companies that are down, that are in a bear market, 20% or more, and then S&P companies that are in a bear market. The numbers are meaningful, and that just creates opportunity. So then you drill down one by one. Has their business been impaired? Is their earnings power impaired? How are they trading relative to history? And then you find discrete opportunities that you can start to put money to work. And that's kind of what we do on a daily basis. And we feel like it's a treasure hunt, and we're happy to do it every day.
If people want to learn more, how can they learn more about Great Hill Capital?
Yeah, so my email, tjh@greathillcapital.com. For people listening into this podcast, you can reach us at 212-951-1478. We also have a podcast, videocast, which is hosted at hedgefundtips.com, which is just a blog that we do, but we do put out weekly research notes that people find extremely valuable in the institutional community and ultra high net worth community.
Okay, great. Tom Hayes, Great Hill Capital LLC. We'll wrap it up on that note. Thank you so much for your time. This has been great. I learned a lot. I hope our listeners did too. So thank you. Thank you to you. Thank you to our listeners. We'll be back again soon with another episode.
Thanks, Andrew. Thanks for having me on.
Thanks for joining us on this episode of the Pitch Podcast. Make sure you check us out online at thepitchboard.com. If you liked our podcast today, please make sure to subscribe to the Pitch Podcast so you don't miss an episode.